This is Bloomberg Crypto, a daily Bloomberg iHeart podcast, and I'm Stacey Marie Ishmael, managing editor of crypto for Bloomberg News. It's Monday, December 12th. What do pandemic stimulus funds, aka stimmy checks, have to do with the recent collapse of crypto prices and of entities like FTX? According to Bloomberg Opinion writer Robert Burgess, also known as Bob, the answer is basically everything. As he wrote in a recent column, and I quote, "When historians look back on the spectacular rise and collapse of the cryptocurrency market, they will conclude that it couldn't have happened without the pandemic, and they'd be right." Is this a controversial opinion?
People were sitting on a lot of cash and not having anything to do. So a lot of this money had to go somewhere. And I believe that, crypto was a natural outlet.
For more, Bob joins us now. Bob, welcome to the podcast.
Thank you for having me.
An absolute pleasure. I couldn't resist quoting your column in which you sort of attributed at least one of the causes for the current collapse in the crypto market to easy money. Can you say more about that?
Yeah, when all this went down, starting earlier this month in November, I wanted to put the crash in the crypto markets and the bankruptcy of FTX into a bit of a long-term context. And to me, it was as plain as day that the rise of crypto and the speculative excesses that we've seen were a direct result of more than a dozen years of easy money policies.
And, more than a dozen years, that's sort of going back to what my friends in econ like to talk about in terms of quantitative easing, which whenever I ask them to define it, they kind of run away. So I'm going to ask you to just explain exactly what that is.
Sure. I guess, just for a little bit of a preamble, coming out of the financial crisis of 2008 and 2009, when the financial system basically seized up, the Federal Reserve and other central banks essentially started printing money that they can inject directly into the financial system so that the plumbing of the financial system kept running. I mean, we were very close to you walking up to your local ATM and not having any money spit out of it. That's how severe that episode was. And the way the central banks do this is, they basically create money and buy bonds and other financial assets, and that money that they use to purchase those assets go right into the financial system.
And to use a phrase from your column, you wrote, the financial system was overwhelmed with cash in a remarkably short period of time, citing that data point that you've just shared. Draw a picture for me of how we get from, central banks trying to bail out the financial system in a crisis to crypto prices going higher and then lower.
Yeah, I think that at the beginning of the pandemic, when economies around the world were locked down, that's when things really picked up. Central banks increased their level of quantitative easing, and governments were forced to do some level of fiscal stimulus, whether it's through the loans that the government gave businesses to see them through the tough times, or whether it was the extra unemployment benefits that the governments were giving laid off workers, and sometimes, even direct payments. The global money supply of the U.S., China, Eurozone, Japan, and 8 other major developed economies surged by $21.5 trillion over 2020 and 2021 as governments and central banks tried to save their economies. And that the money supply went to 102 trillion. And just once again, just to put that in context, that 21.5 trillion of cash that was created over those 2 years was more than the previous 7 years combined. It was just a tremendous amount of money going into the financial system in a very short period of time.
So you've got a fair amount of discretionary income, right? You know, people are able to meet their basic needs. Also, they couldn't really go outside and do stuff. So they were looking for needs that, you know, we were looking for needs that we could meet from lockdown. Your premise is that at least some of that additional discretionary income flowed into cryptocurrencies.
Yeah, and it wasn't just discretionary income. I mean, just look at it another way. Just using the United States as a specific example, economists look at something called excess savings, which is basically just money that you have in your savings account. Usually that stands at around $1.25 trillion. And it's been pretty steady, over the last 10 years leading into 2020. But because of all these programs, that number, that excess savings that people have in their checking accounts shot up to $4.5 trillion from $1.25 trillion. So people were sitting on a lot of cash and not having anything to do, not being able to do anything with it. So what they did is they was like, well, let's invest this money. They're not going to go into bonds because bonds were paying nothing at the time, right? Just consider that we had $18 trillion of bonds that actually paid negative yields, right? Meaning that you were paying governments to hold your money. Stock prices, stock values were at record highs. So a lot of this money had to go somewhere. And I believe that, crypto was a natural outlet. And I think you can see that in some of the data about the crypto industry, right? We went from less than 3,000 cryptocurrencies in 2019 to over 10,000 by 2022. That's an amazing amount of growth.
Well, as we've reported, as my colleagues have reported, and we've mentioned in this podcast, most of those tokens are what we would call like zombie coins, right? Like they don't super trade. They're not particularly liquid. Their market value is in the tens of dollars, of the hundreds of dollars in some cases. But I'm interested in this because, I can't remember if I've shared on the show. So if it's the first time, welcome to everybody. I've long had a theory that there is an impulse shared by certain kinds of speculators in crypto, which is similar to the energy we store around like meme stocks that we see in online betting, in sports betting, where it's a combination of, I have some excess savings, as you say, this is fun, risk is fun, these returns seem interesting, there's a community around this, whether it's a message board or a Reddit group or like an athlete telling you should buy Bitcoin. So do you think that the move into crypto was going to happen kind of anyway because it was an asset class that was attracting attention? Or was there anything about 2020, 2021 that induced more people than you might expect in that direction?
In my column, I think I was pretty clear in the sense that I didn't think that we would have seen all the excesses that we did in the crypto market over 2020 and 2021. And by the way, in other financial assets as well, right? Whether it be the stock market, which had a tremendous run, whether it be in housing, right, which had a tremendous run, prices rising much more than they have been historically. And crypto is just part of that, right? And so, what happened in the crypto market didn't happen in isolation. It was also happening in conjunction with what we were seeing in other financial assets. So I think that, if the pandemic didn't come along, if the central banks didn't ramp up their easy money policies, if the governments did not start pumping trillions of dollars into the economy through fiscal stimulus, we probably wouldn't have seen what we saw in the crypto market over 2020 and 2021.
We'll be right back with more from Bloomberg's Bob Burgess. Now, one of your charts, because we love a chart, we're Bloomberg, so one of the charts in your column pointed out the fact that as interest rates started rising, crypto prices started falling. So there's kind of a clear correlation there. But what for you is the causation? Was it that people were like, ooh, bonds suddenly seem more attractive? Is there really an investor whose like choices are between Bitcoin and bonds, or was something else going on here?
Yeah, I think it's sort of a combination of all that. In markets, it's always impossible to boil it down to one sort of common denominator. But a big thing, I think, is just the issue of alternatives, right? I mean, there was this acronym that was invented called TINA, T-I-N-A. There is no alternative to stocks, right? And that's why we saw the big, surge in the stock market, because people didn't want to buy bonds because the bonds were paying nothing. You can go to your bank and you can look at your passbook savings account and you're getting just a couple of basis points. And the same thing on certificates of deposit, they were paying nothing. And where else were you going to put your money, right? But now that's starting to turn a bit, right? There are alternatives. You just look at the lowly treasury bills, right? You can give your money to the government for 3 months and get a 4% rate of return on that. That's pretty attractive, I think that's drawing a lot of money, out of the crypto market and out of the stock market and some of these other places where we've seen excesses.
Given that premise, do you think, in the unlikely event that interest rates are going to fall dramatically anytime soon, that where we are with crypto is where it's likely to sort of persist?
That's a good question. I have no idea what would happen in the crypto market. I mean, if you look at the history, of the crypto market going back to 2006 and 7, there's a history of tremendous booms and busts, and you can't rule that out happening again. But I think it would also, come down to, if interest rates do start to decline, why are they declining? Right? I mean, are they declining because we've beaten inflation, or are we declining because the economy is just in such horrible shape that we're in a deep recession? If it's the latter is the case, then I think people are going to hunker down and not going to be looking at making sort of looking at speculative assets to put their money. They'll look to save it.
Well, Bob, thank you so much for taking the time to join the podcast today. I really appreciate it.
Thank you for having me.
You can find more of his work on the Bloomberg Terminal and on Bloomberg.com. And if you feel so moved, you can check out our twice-weekly newsletter, which is called Bloomberg Crypto. This is Bloomberg Crypto, a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts. Send us your comments, questions, or suggestions for the show to crypto@bloomberg.net. The supervising producer of Bloomberg Crypto is Vicky Vergolina. Our senior producer is Janet Babin. Our producers are Mohammed Farouk and Sharon Barrero. Our associate producers are Ty Butler and Moses Undum. Desta Wonderad is our engineer. Original music by Leo Sidran. I'm Stacey Marie Ishmael. We'll be back tomorrow.